Hello friends. I am Fin Guru. Welcome to my channel Fin Gyan. You are at right place if you are a student or sales professional in banking and financial sector or investor who is very new to investment in financial instruments like stocks and mutual funds. Our aim is to promote financial literacy amongst common people and help new investor and those working in financial sector, especially in sales. We will bring various useful topics related to finance, investment, taxation, and analysis of various mutual fund schemes. If you want any specific topic or fund or stock to be discussed and analyzed, then write in comment box. Let's begin with basics. For investment, one must have savings. Saving is simple, what is left after consumption from your earning. So to increase saving, either earning should be increased or consumption should be decreased. Now suppose you have savings which is lying idle in bank account, and you want to put it somewhere where it can generate some good return. Broadly, you have two options. First, where there is little or no risk but your return is lesser. Second, where your capital might be at risk but reward is also big. Now let's understand the another aspects of investment. There are businessmen running companies with sole purpose of profit making. To expand their business, they need money. These companies has two options of raising money. First, they can borrow from bank. Second, they can go to public either to borrow or to sell their company partially and virtually, allowing buyer to hold ownership in company. When companies go to public to raise money, they issue some notes paper carrying terms and conditions. Companies which issue these paper called issuer, and those to whom it is issued called holder. In case companies borrows from public, these paper called debt instrument. And in case companies sell their ownership, these paper called share or equity. Now we know in financial investment avenue everything can be divided into two category: debt and equity or share. Debt and equity has different characteristics. Let's understand debt first. Instruments are also called fixed income instrument. This is very vast topic and we will make a series on fixed income. For now, let's understand its basic characteristics. Debt instruments or fixed income instruments are less or negligible risky for lender or investor. Here borrower carry operational risk and lender does not share or carry any risk. These instruments are issued for different time horizon and at different rate of interest. Bank FD is also a kind of debt instrument where bank issues FD receipt and investor or holder gets fixed return after a particular time mentioned in terms and conditions of FD. Second option with companies to raise fund from public is to sell ownership in company. Those who put money in this option are given share of company and called shareholder. Shareholders are owner of the company up to corresponding amount of share he/she is holding. Shareholders are owners, so he/she carry risk of profit or loss. Shareholders are not entitled for fixed return. Their return depends on performance of company. It might be very high or capital loss can also be there. To summarize what we learnt in this video, there are broadly two avenues of investment: debt and equity. Debt instruments has no or negligible risk of capital loss but less return. Equity has risk of capital loss but may yield a higher return. Hope you have liked the video. Our next videos will be on ULIPs, mutual fund stocks and fixed income instruments. Do like, share our videos and do not forget to press bell icon. Take care.